Welcome to the Synapse Energy Economics Third Thursday webinar. It's a special edition happening this month on the second Thursday, so thanks for joining us. This month we're going to be talking about alternatives to the Tampa Electric Company's gas project. We've got two speakers with us today. We've got Synapse's own Devi Glick, and then we also have Kevin Lucas, who's the Director of Rate Design at the Solar Energy Industries Association. Kevin, just want to make sure you're on the line. Can you hear us? Okay, I think Kevin's on there. We'll make sure that he's online in just a couple of minutes. But while we're making sure he's on there, I just want to talk about logistics really quickly. So this webinar is being recorded. All attendees have been muted upon entry, just to make sure that we don't have any noise happening, and you'll remain muted throughout the webinar. If you have any questions, though, we do really want to hear them. So you can send those questions to webinar@synapse-energy.com. If you have any questions about technical issues that you're experiencing, please send a chat via the chat feature to the host, and we will do our best to help out and make sure that you're good to go. Also, while we're talking, make sure that you mark your calendars for our next webinar, which is actually next week. We will be talking about energy subsidies on Thursday, May 16th at 2 p.m. And with that, I think we're ready to get started, so I'm going to hand it over to Devi Glick.
Great, thank you, Bridget. As Bridget said, today we're going to be talking about cleaner, lower-cost alternatives to Tampa Electric Company's billion-dollar gas project. And this is a Sierra Club project that we participated in. Just going to start with a little bit of background on who the Tampa Electric Company is, which I'll be referring to as TECO. It is an electric utility in Tampa, Florida, serves about 750,000 people, has about 4,700 megawatts of generating capacity, several combined cycle units, a couple of coal units, and a little bit of solar, about 400 megawatts currently, with quite a bit more, 600 megawatts more coming on by 2021, and then another 600 megawatts planned beyond there for 2023. TECO uses a 10-year site plan process for its long-term resource planning. So for anyone familiar with resource planning processes, this is a little bit different than the really robust integrated resource planning process that's used in other states throughout the country. And the company has very low energy efficiency, demand-side management investment currently, and pretty low goals going forward to the future for their energy efficiency. So that's just a little bit of background on the utility. The case that we're talking about today was TECO's application to modernize an existing steam plant, and you'll notice modernize is in quotation marks. So the company is proposing to basically repower an existing gas-fired facility as a combined cycle facility. So you reuse an existing steam turbine from one of the units, Unit 1 officially, retire Unit 2, and then the other two units, 3 and 4, would just maintain as coal-fired units as they were. And the price tag for this project is $895 million in capital, so just under $1 billion, just upfront, in addition to any ongoing, fuel operations and maintenance costs. And those costs over the lifetime of the project dwarf this upfront capital cost. So the venue for this application was an administrative law judge was where this hearing was. So it was a siting board application. The siting board falls under the Department of Environmental Quality, and TECO was applying for this siting board application under a Power Plant Siting Act. The Power Plant Siting Act basically says anytime a company expands the steam generating capacity of its units, it has to apply for a siting permit.
Debbie, can you explain why the venue is important?
Yeah, so the administrative context, being in front of an administrative law judge for a siting board, is a little different than where we normally will be discussing new projects and new plants. So generally we're doing that at the Public Utility Commission level, public utility commissions usually are responsible for approving new generation projects. They look at the proposed project in the context of the utility's need. So this means they look at demand, at the utility's existing resources, at the utility's demand-side management programs, and really does a full review. And this usually happens prior to a project reaching a siting board.
Okay, great. So did a PUC review and approve TECO's plan prior to this administrative hearing?
No, and that's the problem here, is that TECO, they claim that this is not a new project. It is just a quote-unquote modernization because they're reusing an existing steam turbine. They claim there's no net increase in the steam generating capacity, so this is a lovely loophole in the Power Plant Siting Act that was designed when steam generation was synonymous with electricity generation. So the utility claims there's no new steam capacity being added, when in reality the plant's net capacity increases about 285 megawatts in the summer and 325 megawatts in the winter relative to what's currently on the ground. The company also claims that this project will result in a net decrease of emissions relative to the baseline. And in reality, the two units, they make this claim based on the assertion that the current units are run on coal, when in reality the two units are currently running on gas, and so they're operating at very low capacity factors and on gas. So in reality, the project will not, in fact, result in a net decrease in emissions. So the main focus of our analysis here was to, in this context of where this being at the siting board of the Public Utility Commission, we were analyzing the electrical energy needs of TECO's customers. We were evaluating the cost and impact of the plant, and we are evaluating lower cost methods to meet the needs of TECO's customers. So this includes solar, which you're going to hear Kevin talk a bit more about, energy efficiency, and battery storage. So that was what we were doing for this project. And just a brief summary of our findings, which we're going to go into in much more detail. So first, TECO, the company, used a faulty baseline to make an unsupported claim about the benefits that this project would provide to both ratepayers, both economically and environmentally. This claim, it was based on the company over-projecting how much its peak load growth was going to go up over the next 10 years. And there was some technically unsupported modeling that they used to support this. The company has historically and continues to underinvest significantly in energy efficiency. So they lag nationally. They lag many other states in terms of how much they're investing in energy efficiency, which we all know energy efficiency is the lowest cost resource out there. The company also does not have any real capacity needs over the next decade if they invested in reasonable levels of energy efficiency. Additionally, they don't actually need the energy. So they don't need the capacity and they don't need the energy from the project. The company did not consider whether maintaining the current units that it's planning to quote-unquote modernize, they didn't consider keeping them as just peaking resources. So if they claim they have a capacity need, they could keep those existing units as very low operating peaking resources. They did not consider this. They failed to consider other alternatives, so solar, battery storage, and efficiency. And finally, we found that the company could save customers as much as $1.8 billion over the 30-year life of the proposed plant, and reduce carbon emissions by 21 to 31% by investing in alternative resource portfolios. And all of these portfolios offer reasonable and available methods to minimize the adverse effects to the environment. So this is kind of high-level our findings.
Great. Thank you, Devi, for that overview. I'd love to actually go back to your first finding about the baseline. You've mentioned the baseline a few times. So what is this baseline you're talking about, and why is it important?
Yeah, thanks, Bridget. So yeah, that's going back to the first finding, so we'll start there. So the company claims that this project, this gas project, is going to decrease emissions relative to what it's calling a baseline. So what that means is the current level of emissions from the project, or the level of emissions that you would expect the plant that's currently operating to continue to produce going forward. In reality, the plant has been operating on natural gas for the past 2 years, and it's been operating at very low capacity factors. The way the company modeled this net decrease by assuming the plant was operating currently burning coal, which produces significantly more emissions, and also assuming it was operating at a very high capacity factor. So it was using a very misleading and faulty baseline to say that this new project, which will be burning natural gas, would produce less emissions than if they just kept the plant the same. They also claim that the gas project is going to save customers $747 million. That was an unsubstantiated claim. So the basis of their emissions claim was they were using air permit data from 2013 to 2015 when the plant was actually burning coal and operating at a high capacity factor. But as I mentioned, that's not how the plant has operated in the past 2 years. So the plant's currently run on natural gas, as I said, and this chart, what this chart is showing is the emission level from CO2, SOx, and NOx. So that first line, the maximum historic emissions levels from the Big Bend, is what the company was using as its baseline. Whereas if you look at 2018, what the plants actually emitted in 2018, you'll see on that second line significantly less than what the company is claiming is its baseline. So we calculated what the potential emissions are from the gas project when it operates under a combined cycle operation. We took these numbers actually from the company's application. And in reality, the potential emissions from the combined cycle, which is shown on that third line, are significantly higher than the current operation of the plant. So TECO is claiming that the baseline of current operations is that first line, and since their their emissions from the project will be lower, they're claiming the project's better. But in reality, that baseline should be that second line at 860,000 short tons. So what I'm trying to show on this graph here, trying to illustrate the different story you can tell depending on what baseline you select. So that orange bar on the left is showing TECO's claim of the projected lifetime emissions from the Big Bend gas project. The second gray bar shows TECO's claims of what the baseline emissions would be. So they're claiming if they continue to operate the existing plant, that's how many, and that's what the emission level would be. So therefore, obviously, look at that big gap. There's going to be a huge savings. Well, in reality, that if you go all the way to the right and you look at that dark blue bar, we modeled what the emissions level would be if you use their actual baseline, the baseline of how they're currently operating the unit, and we found that there's actually going to be a significant increase in emissions relative to the baseline.
Okay, Debbie, so what about the light blue bars? Do they represent the change in emissions that result from changing your assumption around fuel type or capacity factor?
Yeah, that's right, Bridget. Yeah, sorry, I didn't label to talk about those. So I wanted to be fully transparent about how different assumptions can change the baseline. So essentially, if you're looking at using gas instead of coal as the current fuel type, but you're continuing to assume the plant's operating at really high 2014 capacity factors, then your total emissions would be the gray bar minus that first blue bar. And then if you continue on your way over, there's just differing assumptions around the capacity factor and the operations of the unit. So this is just showing that if, for example, if you added up the two rightmost bars, then you would have the emissions, the baseline emissions if you're using a 2018 capacity factor.
Okay. So it's sounding like TECO's baseline was a little bit misleading. And you mentioned need as well. So what were your findings on TECO's need for the project?
Yeah. So the second kind of main focus of our analysis was need. And by need, we mean how much energy and capacity does the company need to meet customer demand and maintain reliability. So we found that the company's need claim was based on systematic overprojection of peak demand and load growth and some technically unsupported winter peak modeling assumptions. Additionally, they had an unnecessary high planning reserve margin. So that means they were claiming they needed to build capacity for contingency for backup to a unnecessarily high level. So they claim that they need these two, the Big Bend gas project, in addition to, we haven't even mentioned yet, 2 unsited additional combustion turbines. But in reality, they haven't proven that they needed any of this. Once again, they're very minimal investment in EE, and they're using a 20% reserve margin. And in context, the FRCC in Florida only uses a 15% reserve margin. So the TECO's reserve margin is higher than the Reliability Council in the region. And additionally, they did not, in their application, include an additional 600 megawatts of solar that has been planned, that was not included in their 10-year site plan, which was the basis for their need assertion. So this is just, this table shows their baseline future capacity needs. So what we did was we took their need claim and we said, okay, how much do they actually need in each year? So breaking it down by winter and by summer, and what is the reserve margin for each year? So their baseline capacity need, what they claim they need, is shown here. So 394 megawatts in 2030, 165 in the winter, 165 megawatts in 2023, in the summer. So this is just showing the baseline capacity needs that TECO is claiming. So we took a look at their demand forecast, so their net energy load demand forecast. So we looked at their base case, their low case, and their high case. And as you can see, they're projecting an increase in load growth in each year. And this increase that they're projecting does not match what has historically happened. So they have been projecting increased demand, and there has been very minimal growth historically. So every year they project an increase in demand, and there's actually, that growth does not materialize. So we looked at their winter peak demand forecast, for example. So if you look at the blue line represents their retail and wholesale. So summer is in yellow, and winter is in blue. So this combines their historic patterns as well as their future projections. So there's a pretty big jump between 2017 and 2018 in their projected winter peak demand. And we could not find support in their modeling assumptions for this jump in demand. And this was driving a significant portion of their future capacity needs, so their need for this project.
I'm just going to jump in. We have a question that's going back to your finding on savings. So you said that TECO's estimate of savings of around $700 million was unsubstantiated. So do you think that this might be correct? And what sort of substantiation might you normally expect from a utility?
Yeah, so we basically were allowed to get confidential information from them to try to figure out how they came to those calculations and those numbers. They refused to provide any level of granularity or detail. The best that we could discern from this was that they were calculating those savings relative to the assumption that the plants would continue to operate on coal going forward. And coal operation has a pretty high forward-looking operational cost. And it's not realistic. It's not there's no future in which TECO would actually realistically continue to operate those plants at really high capacity factors on coal. So they were calculating the cost of a plant operating in a manner at which there's no reason to believe they would ever actually operate that plant going forward. So that's why I would say unsubstantiated and a faulty baseline. So you should use a baseline that represents what reality would look like in the absence of this new plant, not based on the reality that creates the best looking alternative for you, which is essentially what they did.
Right. Thank you.
Yeah, thanks for that question, Bridget. Okay. So next we looked at, I'm jumping ahead here. We looked at the Tampa Electric's investment in energy efficiency and demand-side management. And this is important because energy efficiency and demand-side management reduces demand. It's historically has been and continues to be the cheapest way to achieve energy savings. And TECO lags the national average significantly. It's way below average in terms of investment energy efficiency. And the interesting thing is, as much as they lag the national average in terms of what they're actually investing, they also lag in terms of their goals going forward. And so they're actually achieving higher levels of savings than their goals going forward. Now, this might sound like a good thing, but the hitch is that the company claims that they need the energy and capacity from this plant. In order to support that claim, they use their forward-looking projections of what their demand's going to be. And in their forward-looking projections of their demand, they're modeling very low levels of energy efficiency adoption. They're saying that their goals are really low. So when they achieve higher levels than they actually model, that means they're over-projecting how much energy they need and how much capacity they need from the plant and other resources. So they're modeling lower levels of efficiency than they know they can achieve because they're currently achieving higher levels of efficiency than they're modeling to justify the fact that they claim they need this plant, the energy and the capacity from it. So it's interesting. You don't usually see utilities underselling themselves in terms of energy efficiency, but it's serving their purpose in this case, so they're doing that. So we found that the company actually has zero capacity needs. This is one of our main conclusions over the next decade. So we found if the company corrects its load forecast, increases energy efficiency, so we modeled an increasing level of efficiency where they've reached the national average by, I think, 2023 or 2025. So this was a very modest, not an aggressive increase in energy efficiency to reach the current national average, the national average will be higher than that in the future. So they're still going to be below the national average based on what we modeled. They will need no new capacity over the next decade. And that's really important because if you don't need new capacity over the next decade, you don't need it until after 2029, the cost of renewables and of solar, of battery storage, will have come down significantly in 10 years relative to how much it would cost today to build any of those resources or, the new plant. The cost of renewables has come down significantly as it is today, and imagine how much more it will have come down a decade from now. So what this table is showing is the companies are modeling of the company's winter capacity and summer capacity needs with different scenarios. So if you add in the 600 megawatts of solar that the company has clearly stated they plan to build, your capacity need is 691 megawatts. If you decrease the demand growth projection, so you use the company's own lower demand projection, you immediately drop your winter capacity need by 247 megawatts. If you use a lower reserve margin, if you use energy efficiency. So this table is just showing, as you add in incremental and reasonable assumptions that the company should have modeled and tested, how does your demand change? And that last line shows that if you add energy efficiency to the winter-corrected peak load, so we looked at their modeling and we found technically unsupported assumption in heating degree days. So if you correct that unsupported assumption that we found, you add in that second 100 megawatts of solar, you add in energy efficiency, then you actually have that's what produces the zero capacity need over the next decade. Sorry, this next slide, I'm not going to talk through this. This basically just runs through a lot of what I just talked about. The reserve margin assumptions that we looked at, investment in efficiency, demand projections that are more reasonable, and different results that you see. Another one of our findings, which I've already mentioned, is that the company did not consider maintaining units 1 and 2 as gas-fired peaking capacity resources. And all that means is if they need capacity for backup for the reserve margin, and they're only running these units at really low capacity factors. So you can see if you look at the far right side of the screen where it says 2018 capacity factors, Big Bend 1 and 2 were running below at 20% or below. So if you keep those resources and you barely run them, they did not model that as an option where you basically use solar and efficiency to make up the majority of the energy, and then you use these as the capacity resources. Another really interesting thing we found was that the company does not need the energy from the gas plant. So TECO just invested in 2017 $400 million to upgrade another one of its combined cycle plants. the Polk unit. It also has 2 other combined cycle plants, Bayside 1 and Bayside 2. And the company's own modeling showed us that their plan was to ramp down the amount of energy generation from its other 3 combined cycle plants when it brought Big Bend on. So we found that 84 to 95% of the energy that the company was planning to use from Big Bend could actually be met by continuing to operate these other 3 plants at the levels that the company modeled them operating at prior to Big Bend coming online. So almost all of the energy that the company is modeling Big Bend is generating can come from the 3 existing combined cycle plants. It's ridiculous that it spends this much money to upgrade a plant 2 years ago and now is building another one and does not even need the energy from this energy resource. Let's see, next slide. So we feel very strongly that the company does not need to spend $895 million in capital costs on this plant. These tables just show the total installed cost of the unit. So the Big Bend 5 and 6 BT, those are, and Big Bend ST, those are just the 3 different components of this Big Bend project, the total project. So we did our own calculations, and it might be confusing to see the $818 million dollar number, but that was the closest we were able to get to back out the same calculations that the company did. So that's similar to the $895 million number that the company came up with. In addition, the company has 2 other unsited combustion turbines that it also plans to build on this site in 2023 time period. So this is actually a larger project than just the combined cycle. There's the additional capacity resources of the 2 CTs. And so we calculated the revenue requirement of this project over the 30-year timeline from 2023 to 2052, and adding in fixed operations and maintenance, variable O&M, fuel costs, and found a total revenue requirement of $6.6 billion over this 30-year time frame.
So Debbie, here's the $895 million question.
Yes.
If TECO has 0 capacity need and the Big Bend project is a big waste of money, then why does TECO want to do this project?
So when the company builds this project, they get a regulated rate of return that gets given back to the ratepayers. So TECO is owned by a company called Emera. So Emera's shareholders rather, get this regulated rate of return on these capital investments. And the ratepayers that live in Tampa, which include my 2 cousins and their 6-month-old baby, electricity bills go up as they build this gas plant with a, 20-foot seawall because it's on the ocean and you need to protect it from sea level rise. There's no irony in that. So that Emera's shareholders can get the regulated rate of return from TECO, which is probably their only profitable entity right now.
Okay.
Yeah. So, and this is where Kevin might have some things to add. The TECO did not consider alternative resources. They did not consider additional utility scale solar, which can provide valuable summer peaking capacity and minimize the need for the company to run gas or coal-fired units in the summer. They did not consider battery storage, which can firm up solar and provide a crucial winter and also summer peaking resource. They didn't look at energy efficiency, which is, I'll say again, it is and it continues to be the lowest cost resource for TECO. Kevin, I don't know if you want to jump in here and add some stuff. I know this would be a great time.
Yeah, I think I will. Everyone can hear me okay? We had a little technical issue earlier.
Yeah, you're great, Kevin.
Okay, great. Thanks, Debbie, for running through this. So I think the folks on the phone are probably getting a sense of, frankly, just how absurd this process was. We participate in a bunch of rate cases and other procedures. We're always dealing with the issue of information asymmetry, where the utility knows more about their operations and comes in with the first pass at all the modeling and all the assumptions. And it's up to parties like us to get into these proceedings and dig into it and pick it apart. And it's often the case that you will find a questionable assumption here or maybe an innocent mistake there, and then you kind of haggle over what the right way forward is on that. But the total number of what just are well beyond innocent mistakes that we had in this particular case, it was by far, I think, the most egregious example of a utility filing manipulating the information to favor what they're doing. I mean, when you have letters that you've sent into the EPA saying we've permanently converted this plant to run on natural gas, and then you have a model that says, oh, we're going to run on coal and baseline everything off of that, and that goes a step beyond just making some questionable assumptions about forecasting and whatnot. So I think Debbie did a great job in her analysis tearing this thing to pieces. And if this were in the venue that it should have been in, I think we would be in a very, very strong position to have fully refuted all these technical analyses and models that came out of the case. Unfortunately, as Debbie's going to probably say in a slide or two, that wasn't the case. But I'll let her circle back on that. The one thing that I did want to kind of chime in a little bit here is I did some work on some potential alternatives. So notwithstanding the fact that they don't really have a need to build this plant, there was kind of a second parallel approach that you were taking that says, putting all of that aside and assuming that you do actually need to build this plant, is this specific project the best way to go forward? And so my testimony focused on a number of different kind of overviews and trends in the solar industry. I had some information, showing how substantially costs are falling, showing that, Florida is beginning to ramp up its deployment, that the industry itself has ramped up and matured to a point where it is increasingly cost competitive when utilities actually go out and do competitive procurements for all source resources, that solar and solar plus storage are winning those bids. So my testimony was based on the analysis that the gas plant that they are proposing to build was actually the wrong choice to meet the need that they may or may not have. Well, what they don't have, but what they at least claimed that they had. And so it was talking through the alternatives and the benefits that solar provides. On the one hand, just from a purely economic standpoint, by the time they actually have the need in 2 or 3 years, the data that the National Renewable Energy Laboratory Lab puts out shows that PV is going to be cheaper on a levelized basis than a natural gas combined cycle plant, even a very efficient natural gas combined cycle plant that they're proposing here. And when you consider over the lifetime of that plant, only about 20% of the costs are actually from the capital. The rest is based on fuel. And when you have a solar facility where almost all of the costs are upfront in capital and you have zero cost fuel for the lifetime of the project, that makes a big difference in terms of securing long-term stable pricing. There's a specific value to being able to hedge out some of that volatility, particularly as TECO gets more and more concentrated in natural gas generation. The other thing that I did not testify on, but I will agree with Debbie's analysis, is the energy efficiency assumptions are ridiculous. I mean, the goals that they have there at less than 1/10 of 1% per year, I mean, those are 1/20th the levels that leading states are making. And in a place like Florida, where they have not had a strong history of efficiency, where they have a tremendous amount of air conditioning load, the opportunities down there are amazing. So the fact that the utility is intentionally avoiding this, the fact that Florida, the commission or the legislature hasn't gotten themselves together to have actual goals here. I mean, these goals are they're just ridiculous at how low these are, compared to other leading states. So the combination of those two things is a little bit depressing to see at times. Before working at SEIA, I worked for an energy efficiency organization, so I still hold that a little bit near to my heart. But on the solar piece and the testimony that we pushed on, it was a combination of the technology, that they were using the wrong technology, but it was also the way that they were approaching it. So Debbie did include in this that they are planning to build solar. So even TECO has acknowledged and recognized the economic argument for why solar makes sense to meet a portion of their load. The problem, though, is the way that they're going about it is not the way that is going to lead to good results for the customers. It's going to be a way to get good results for their shareholders. And that's because Florida has a rule where if a plant is under 75 megawatts, then the utility doesn't have to go out for a competitive procurement. And none of you on the phone will be surprised that all the big solar projects in Florida are either 74.5 or 74.9 megawatts. Because again, it's designed in a way for the utility to be able to own these assets without the forces of the competitive market to keep prices down, to be able to get more assets into the rate base on which they earn. So at the very least, if the company is going to own the asset, and you can have a legitimate argument as to whether that's appropriate or not, the commission should require, it should close this loophole on the 75 megawatts, and it should require the companies to go out for a competitive bid. Because there's no point in the company's customers paying more for the same asset simply because they're not going out to a competitive bid. I think a better approach, though, would be to allow third-party competition, to truly allow third-party competition for this, and to allow or require the utilities to sign power purchase agreements. These are structures where the utility would not own the asset, but they would simply buy the output from the facility. And because of differences in how the tax code works, third-party developers can actually offer much lower costs for the sale of the energy than the utility would be able to if it owned the project. So there was actually some projects that were, some PPAs that were signed up in Jacksonville where they were able to undercut their variable costs, just not even their capacity or anything else, just the variable cost of their energy by about 20% by signing long-term flat rate solar PPAs. So, you know, TECO is kind of pulling one over on their customers in multiple directions here. You know, first they're putting forward an argument about a plant they simply don't need, and then in the alternative, they're building their alternatives in a way that maximizes the costs, which in turn, you know, maximizes the shareholder returns, rather than actually following a process that will minimize the cost to their customer. So it was a little bit disheartening that, you know, we weren't able to bring all these arguments forward because of jurisdictional issues. Because I tell you, if this case were in the right jurisdiction and was being heard in front of the commission and we were able to make these arguments, I think we would have an extremely compelling series of arguments to put forth. I'll stop there.
Great, thanks, Evan. That was perfect. So I'm now going to show the final results of when we modeled a lot of the solar build out going further. So as Kevin said, you know, putting aside the fact that they don't necessarily need the energy or capacity, we did still model what an alternative portfolio would look like. And we found with this alternative portfolio had solar, it had battery storage, it had increased energy efficiency investment, it had a lower demand, so it used the TECO's own lower demand projection. It also deferred some of the capacity builds, so there's a time value of deferring the builds, and because it relied on much less generation from gas power generation, natural gas costs were significantly lower. We found that TECO can save customers $1.8 billion over the 30 years and reduce emissions 21 to 31% with an alternative portfolio. So this is, you know, adding in energy efficiency, adding in solar, adding in battery storage. So what this table shows is the revenue requirement, the cost under the different scenarios. So the revenue requirement of the original project, you know, $6.6 billion, compared to the revenue requirements when we modeled a low demand scenario without the gas project, so with our alternative, with the reduction in the revenue requirement was $744,000, or I guess $million is $1 million. And then when we modeled energy efficiency on top of the low demand, that number dropped to $1.8 billion in savings relative to the revenue requirement required for the gas plant. And that's just the monetary savings. And there's also, as we said, the really, really crucial emission savings relative to the gas project, which is 21% when you don't include energy efficiency and 31% when you do include energy efficiency. So just huge energy and economic savings for the customers. So the outcome of this, at the hearing, Kevin and myself, as well as my colleague, Bruce Bewald, we were not allowed to testify. And this is because at the administrative hearing under the siting board jurisdiction, the siting board and the Department of Environmental Quality, which is the entity that houses the siting board, they made the claim that we solidly disagree with, that the need assessment and the alternative consideration was outside of their jurisdiction. So as we said, this did not go in front of the Public Utility Commission, and then the siting board and the Department of Environmental Quality claimed that these issues were also outside of their jurisdiction, and they refused to hear our testimony, meaning that literally nobody has, in this case apparently, has to look at whether the utility actually needs $895 million project that is going to be put on the ratepayers in TECO's area. So we were not allowed to testify. Our testimony was what's called proffered, meaning it will be available on appeal, but it's not actually available to the siting board. So we were testifying in front of an administrative law judge. She makes a recommendation to the siting board, and the siting board will make the final decision on whether or not TECO can build this power plant on this current site of the Big Bend unit with its seawall to protect it from sea level rise caused by climate change, caused by burning the gas, the whole vicious cycle. So yeah, that's we're currently waiting for the siting board recommendation. So that's where we're at currently, and we're hoping to continue some work with the Sierra Club on this, looking at doing some more rigorous modeling for both TECO and for the entire state, looking at how to move the state away from its addiction to new gas plants.
Okay, thank you so much, Debbie and Kevin. We do still have a little bit of time left, so if anyone has any questions, you can definitely still send them in to webinar@synapse-energy, and we'll get to them if we can. The first one, we actually have one for Kevin. You mentioned some long-term solar PPAs in Florida. So can you tell us about the prices for those PPAs?
Yeah, happy to. I actually happen to have my testimony open because I had all this written down. The examples, so there's a couple from Florida as well as Georgia. Georgia's had a few tranches of competitively issued, for Georgia Power, competitively issued PPAs. In 2017, their average price was $36 a megawatt hour, and they have recently done an additional RFP for 540 megawatts that are going to be coming out later this year. So the prices between the 2017 numbers and the current one are likely to come down some as well. Another good data point in Jacksonville, that was the one in Florida I was talking about for JEA, those were 25-year contracts with a flat price of $26 a megawatt hour. So that was actually 20% below their current supply costs. And a big reason why JEA went this approach is they kind of got caught up in a lot of the issues with the nuclear plant cost overruns, which they had agreed to buy a piece of. And so when you compare what they're going to be paying for energy on the solar PPAs compared to what they're going to be paying whenever it gets done for the nuclear costs, it's a substantial difference in price. So those are two examples right there. There are another couple examples that are out. Excel in Colorado had an RFP a couple of years ago where the median prices for PV came in around $29. There was an RFP in northern Indiana, which doesn't have nearly as good of a resource, a solar resource as does Florida, where they were seeing also in that instance, that solar and solar plus storage was winning competitive procurements. So, we are seeing in good resource areas, solar PPA prices for 25 to 30 years that are in that sort of mid-20s to low 30s range based on where prices are at today. The prices are continuing to come down. There is currently a step down in the federal investment tax credit, which it's a little bit complicated. Basically, over the next couple of years, the tax credit will be reduced, but the industry is positioning itself pretty well to be able to weather through that as the actual cost of the technology falls alongside that. So we anticipate on a go-forward basis to continue to see these very aggressive PPA prices, and we want to make sure that customers have access to this. It's not a great outcome when the utility locks everything up and doesn't allow their customers to actually get to this lower cost energy.
Thanks, Kevin. So it looks like we don't have any more questions coming in, so we'll wrap up. As a reminder, we do have another webinar coming up next week. That's Thursday, May 16th at 2 p.m. We'll be talking about energy subsidies. Also, if you want to learn more about this Florida docket, our webinar from April 18th, a recording of that webinar, which was on climate damages and the social cost of carbon with Dr. Frank Ackerman, is up on our website. It's about his testimony, which is actually in the same docket as Debbie and Kevin's testimony. And with that, just want to thank everybody for coming, and thank you again to Kevin and to Debbie for putting together this presentation. It's really illuminating, and hope you all have a great afternoon.